This week, in the preamble, you spoke about Japanese exports up nearly 30% year over year still. There's still plenty of activity going on. So despite, I guess, the doomists and gloomers saying central banks going too far, too fast, too hard, the economic evidence we have is actually the real impact of that tightening is less than we would like to see. Inflation's not behaving itself, and that's why they've got a bit more work to do.
Fed funds futures are pricing in a higher terminal rate of 5%. Are they right to do so?
I think so. That seems about reasonable to me. Look, 6 months ago I would have said 3.5 was probably the right number. 5 seems like the right number. The key thing for me always has been really, yes, there's a level question, but what happens after that? Is it a peak and a nice, a vertical decline after that because there's a recession or some other problem? And the market, I think, is gradually getting to this idea. This is a really fundamentally driven hiking cycle. It's not mostly due to temporary supply-side problems. It's because demand is just way too strong. And so rates are going to have to go up and probably stay up for a while.
Mandy's got a burning question.
Always a burning question. Well, sometimes a burning question. But today it is a burning question because we're thinking a lot about the 87 crash this week because of the 35-year anniversary. And while obviously the reasons for that crash then were very different from the kind of things that we're looking at today, nonetheless, is there anything that you see out there in terms of stress in the system, Richard, that makes you be concerned that maybe we're in for some much tougher times in the market than we're currently experiencing?
That is the million-dollar question, I think. I don't see a lot of sources of stress that I can identify that are significant enough to cause meaningful problems. There are absolutely economies, mostly at the lower end of the income scale, who are struggling with this combination of a strong dollar, high commodity prices and higher US rates. There are bits and bobs in the financial markets in advanced economies where there are vulnerabilities. The UK pension funds, who knew they were running so much leverage to try and deal with very low yields. But generally, I think, rather than there being lots of sources of vulnerability, households in places like the US look to be in super strong shape, and that's frustrating the Fed in its task to try and get inflation back down. So I think, rather than vulnerability, the things I see actually are strength.